Hello and welcome to this episode of Crossing Borders with Nathan Lustig, where I have conversations with entrepreneurs doing business across borders and the people who support them, with a focus on those with some connection to Latin America. My guest today is Federico Antoni, managing partner of ALLVP, a Mexico-based venture capital fund that invests in Latin American startups, including Cornershop, which recently was acquired by Walmart for $225 million. We cover Federico's path from the corporate world to teaching entrepreneurship to starting a $6 million fund in 2012 in Mexico when startups were still not very popular, much less venture capital funds. Their growth to a second $36 million fund and now their third fund, along with the lessons he's learned along the way. We also cover Cornershop's recent acquisition, its effect on Chilean VCs and the debate that's been in the press and in politics in Chile, CORFO's role in the ecosystem in Chile, and how China and US VCs and tech companies are pushing the region forward. We get into the nuts and bolts of a VC fund a bit while talking about Cornershop and CORFO near the end, so if you're more interested in Federico's story, you can skip over that part. I hope you enjoy my conversation with Federico Antoni. Hey Federico, welcome to the podcast. Thanks for taking the time to do it.
Great to be here.
Awesome. So where are you in the world today?
So I'm in Mexico City. That's where I was born, and that's where I'm at, the big city of Mexico.
Awesome. And tell me a little bit about ALLVP. What do you guys do?
So we're an early stage VC fund. What we do, we invest in Latin America with a strategy of four sectors. So we invest in healthcare, we invest in financial services, in smart cities, and consumer internet. And we basically come in or join the teams at the seed stage, A and B rounds, where we are currently investing our fund three, which is brand new. So we're excited about it.
And how long ago did you get started?
So we founded, Fernando, my partner, and I founded OVP in 2012. So a long time ago, we actually came into the business without a prior experience related to venture capital. So we didn't work at a VC before, or we didn't create and sell our startup before. Uh, and we started slow, and we started with a bet actually. We started by creating a fund one that was a $6 million fund that we deployed pretty quickly, and that allows us to learn very fast, we think, and that allowed us to prove that we could invest, that we could help companies, and that there was an opportunity in Mexico and in the rest of LatAm.
And more or less, how many companies and how much money have you guys invested, and what have been some of the most successful companies that you've worked with?
So we've invested two funds. The first fund, as I said, is a $6 million fund. Then we invested our second fund, which is a $36 million fund. So a bit over 40 million deployed already. We have invested in 25 companies. Um, in general, we do several rounds on each of those. Exciting companies. Well, we are still early in the game, so we have some promising companies definitely. We have had four exits, which is pretty good for a fund this recent. So we've sold two companies in fund one and two companies in fund two. Sorry. One of those is our big recent validation, which is Cornershop. Um, so we're very happy about that. We have a couple of companies that are doing fantastically well. For instance, we have an investment in Enlight, a company that helps families and SMEs have access to solar energy. That company is doing very, very well. We are excited about a company called Alcanza. That's a company founded by a Colombian entrepreneur based in Redwood City that is deploying robo advising capabilities within financial services companies around the world. So that's really exciting, very high tech company. We're excited about a company called Social Diabetes, which is an app that helps uh, patients with diabetes to follow and help them control their illness. That company is Spanish. So we have a few of them, and we're very excited about the opportunity of doing tech and solving problems with tech in Latin America.
Yeah, it's an interesting place to be right now with lots and lots of new companies coming into the market, lots of funds that weren't around before or weren't looking at Latin America starting to make investments in the region, and big companies from around the world starting to look in, which is really fun. Want to jump into more about you and the fund and some of the companies in the Mexican ecosystem in a bit, but I want to go back to you. So you were born in Mexico,
Yes.
and you said that you went into the fund without previous being a founder that exited or potentially in working in a VC. So what did you do between your education through starting the fund?
Um, yeah, so my background is not the typical background of an investor. I've been working in consumer industries previously. So I used to work at a retail company that I ran just before creating OVP. Before that, I worked at L'Oreal, the consumer products company. I also worked at a Brazilian startup called Submarino. I don't know if you know it. Uh, so that was a big e-commerce startups before the internet bubble burst. So I worked at that, and more functionally, I worked in marketing. So my passion has always been around the consumer experience and around brands and around product, and that's basically what drove me in my career, and that's what took me to the jobs I took. And there was something in that career that didn't lead to venture capital that actually helped me a lot, which is the fact that I went to Stanford to get an MBA. And even if I didn't take any venture capital classes or any entrepreneurship classes, which is kind of ironic at Stanford, but being there and meeting the people there and living in the valley for 2 years was actually very important to get into this career.
And what would you say would be your inflection point in your personal career of saying, I have really good jobs in traditional businesses. It's looking start of 2010s, getting into 2012. I want to start a fund and take a risk with a $6 million fund in an area that hadn't historically been too hot yet. And looking back now, as things have completely changed since say 2012, what made you take that leap to start a fund?
Failure. Basically, I failed at turning around the retail company I used to be the CEO of. Um, it was an apparel retail company, a mid-size apparel retail company here in Mexico, uh, pretty traditional in its setup, and the company had a very well known brand called Eduardo's that some of your Mexican listeners must know, and it was an old brand that had a problem in its image. it was kind of old and felt out of fashion. And for a fashion business, that's pretty bad. So I went in and ran the business for 6 years and wasn't able to turn it around. And the company basically failed. And that failure basically gave me the opportunity to reinvent myself. And I didn't reinvent myself on a vacuum. I actually was lucky enough to have started one of my favorite hobbies a few years before, which is teaching. So I've been teaching entrepreneurship for probably 10 years now. And it's interesting because I started teaching with my current partner Fernando at ITAM in 2008. And we started teaching entrepreneurship as a hobby, as a way to learn about the sector, uh, as a way to learn how to teach. And it is that experience that actually led us to create a fund.
That's super interesting, and it actually parallels part of my background before going into starting Magma. When I came back to Chile after we sold our second company, I ended up with some other startup Chile entrepreneurs creating a class called How to Build a Startup, and we ended up teaching it at multiple Chilean universities. And basically, that led to doing everything that an investor does, except the important part of actually giving money to people. So
That's great.
it's interesting that there's been, I think, two other investors on the podcast that also started teaching entrepreneurship classes before they raised a fund. So it's an interesting on ramp to VC. And
There's actually
so,
a great article that I'll share with you later that talks a little bit about the opportunity of having teachers or lecturers going into the real world and become practitioners, and how that can be interesting, and how the framing and the way they see things is actually could actually bring a lot of value.
yeah, we'll put that in the show notes so people can take a look at it. And what would you say would be the top couple of lessons that you learned teaching that you now apply to being an investor?
That's a good one. So first, pitching ideas, right? So as a lecturer, you're basically pitching ideas, right? So you pitch a theory that you learned about. You pitch a recent research. You talk about a relevant case. You pitch a trend. So you're pitching to classrooms of students about different ideas, and that has been very important. So I've after 10 years of teaching at ITAM and at Stanford, I've actually become pretty good at telling stories and conveying um, complex ideas into simple concepts. So I've become pretty good at pitching. And as you know, when you're an investor in Latin America, you pitch your fund a lot and often, and you pitch your companies, your portfolio of companies, a lot and very often. So that has been very useful. So that's the first one. Uh, the second lesson about teaching has to do with the human stories behind all these great things that have been built recently, and getting to understand the cases, because you either teach them or you create or write the cases. You actually get to understand the human perspective, um, of building companies, that I think is very useful.
Yeah, it's really interesting. I think you mentioned that when you had to pitch the fund. So we'll go back to 2011, 2012, when you're going for your first $6 million fund. And at least in Chile at that time, if you said you were an entrepreneur, the vast majority of people would basically think you were homeless and didn't have a job, because it was for people who weren't actually doing anything with their lives. And you're going out and asking people to give you money for a fund to invest in those people. So what was that like in 2011, 2012 when you were raising your first fund?
Very hard, very hard. And there were a couple of things that were very hard to convey. So the first one was the 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 private equity slash venture capital business model, which basically involves you signing or getting commitments from investors to invest in companies that you don't know yet. So that concept is actually pretty difficult to understand to people that are not used to investing in that asset class. So I give you a commitment, and you will choose the companies yourself, and you don't know the companies that you will invest in. So that's a pretty difficult sell. Most of the times, what you get is really people telling you, well, when you get a company, you bring it and I'll invest, right? Um, which is kind of frustrating, frankly. So that's the first difficult thing. The second difficult thing, when you're launching your first fund, is you have really little to show off. So even when we raised our first fund, we had already started a company called Fondeadora, a crowdfunding company, and that was a project on the side, and it became a pretty successful company, but we didn't have experience investing in tech, so we didn't have an angel fund or had several angel investments. So it's pretty tough to convince people that you'll be able to take care of their money and find the right companies. So that's pretty hard. One of the things that we did, which was looking back kind of an interesting idea, was since the fund was going to be so small, the management fees weren't very relevant because of the size. We actually decided to charge zero management fees for that first fund. So basically, we said our pitch was, "Hey, I'm not going to charge you unless we do very well for your money," and that was actually very important.
And besides for having a track record as you raised a second and now a third fund, what has changed in the marketplace or in the attitudes of family offices and wealthy individuals that you've raised from, and potentially institutions? What's changed from say 2012 to 2017, 2018 as you've raised?
So a couple of things, and it's just the beginning, as you know, Nate. First, we have some genuine success cases to show, and it's not our own success cases. I mean, it's companies that have done very well, and that have scaled very fast, that are great examples. Be it Rappi, the Colombian unicorn, or PayClip, the payment system here in Mexico. So we have those stories that are success cases that you can demonstrate and show. So that's very important, and that's intriguing for family offices, and that's intriguing for some of the investors. The other thing that we have today is that there is the pace of innovation in some industries is uh, it's just so fast that corporates are now paying attention. So the banks today are intrigued, and sometimes anxious about the pace of innovation in their industries. Obviously, retail is anxious about the pace of innovation, and it's interesting because it doesn't mean that these industries are being disrupted yet in Latin America. Some of these industries have not yet been disrupted. When you think about the financial systems and banks, for instance, I mean, fintechs are still tiny, tiny, tiny. But what you have is that if they're global corporates, their headquarters are being disrupted. So the pace of innovation in China, in the US, and in some industries in Europe has actually forced the local affiliates to start doing things and start investing. So that has changed a lot.
Yeah, it's interesting. And so, one of the things that we just actually did inside of Magma over the last, we're about to be 5 years old at the end of the year, is that we looked at our investment performance from, say, the first 3 years out of the first fund. And one thing we found is that we made our first investment we ever made was great. But then after that, in the next year, basically everything we did didn't work, and we learned a ton of lessons. And we have that internally, and we'll probably do a podcast in the future with a bunch of the lessons we learned investing and basically throwing away 500K on companies that didn't work. Did you guys have a similar learning curve? And if so, what kind of lessons did you learn from that first fund?
So the quick answer is yes, absolutely. So if you think of Cornershop as a validation of our fund, we it took 17 investments to find Cornershop. So we may have earlier investments that turn out well, but we still had to do 17 investment to find this really good outcome that actually validated our thesis. So that shows you, and that shows not only fund managers, but it shows angel investors that you need to invest in a bunch of companies before finding the good one. And it has to do with not only getting better at choosing them, getting better at attracting them, and getting better at adding value, but it also has to do simply with the numbers. And we're in a probability asset class, and the more you invest, the more probable you'll find a good outcome. So that's very important. From the first one fund to the fund two, and getting into the fund three, the biggest learning, it's actually not very interesting or insightful, is that everything comes down to the team. And you can read that, you can be told that talent is the most important aspect of VC, but living it is very different. And understanding what talent means is very important. So for instance, we didn't invest in technical teams, for instance, in fund one, which looking back was a grave mistake. We invested in first time founders in fund one in general. Fund two, we have a lot of second time, third time, fourth time founders. So there's a lot that we have learned in terms of talent that has been paramount.
Yeah, it's interesting to see. I think the point about second, third, and fourth time founders is really interesting because we're seeing that too with founders that maybe didn't do so well in 2010 to say 2014, or had small wins, and now are taking everything they learned and building a bunch of new businesses. And I think that's one of the most interesting things about what's happening in the market right now.
Absolutely, and we should. I don't know if we should, but the market should do that faster. If anything, founders should after a couple of years should look at reality, look at the numbers, sit down with their investors, and close down a company if it's going nowhere. So we're seeing too many companies that are just making the process of recognizing failure and closing down operation, they're making it much too long. So we need more turnover there.
So let's jump into Cornershop. I've been back in Chile for the last 3 weeks or so, and there's a couple of interesting things that have happened. One is there's a clear Cornershop effect between family offices and funds that are now much more open to at least taking meetings. We've seen that even some of the family offices that decided not to invest in our fund two called us back after the news happened. And I think that's really positive for the ecosystem. But the second part is the debate about the Chilean venture capital ecosystem and all of the different reactions between funds, between politicians, between columnists, and also Danny and Oscar themselves in the press. So, have you read any of that stuff, and can you shed any light onto the VC ecosystem and how it relates to Cornershop?
Sure. So first, I think it's a very healthy debate, and if anything, Cornershop's exit will allow investors to reinvest their money, employees to start angel investing. So that is fantastic. That is like the best byproduct of the Cornershop exit. So the healthy debate is great. It's great for Chile. So Chile, and I try to say this with a lot of care, but Chile has had a couple of things that I think have been detrimental to the VC industry. You have this investor called CORFO that has these, in appearance, very aggressive conditions where basically they're supporting and leveraging a fund that seems to be very pro creation of new firms and new venture capital investors. And actually, in the execution, Corfo has been very slow, and it's very difficult for funds to work with Corfo. So having a bunch of slow VCs is almost like having no VCs, right, Nate? If you're a VC, you need to be fast, and you need to be founder friendly, and you need to be light. And I think that um, Corfo's first approach to investing in funds wasn't the best one. So I think there are two learnings there. The third thing I would say, and it's probably a counterpoint, is that it doesn't really matter if the Latin American VC that backed Cornershop is from Mexico. It doesn't really matter. We should think more regionally, and it's good that it's brought up a lot of debate, and that you have more LPs, and that more people will try to become venture capital investors, and you will have more funds. That's great, but it doesn't really matter. You know what I'm saying?
Totally. I agree that the regional the regional cooperation and just regional success is super important because China and the US, they basically see one area. They don't really differentiate much between Mexico, Brazil, Chile, Peru. It's Latin America.
Exactly. Exactly. And moreover, you wouldn't have the corner shop exit without the Chilean team launching Mexico and Chile at the same time. Impossible in that area.
I think your I think your feedback on Corfo is spot on as well. I mean, we're the only fund in Chile with no Corfo, and we did it specifically because we wanted to be able to go fast, not have to ask for permission to invest, and be able to invest in structures that were more complex than a typical Chilean investment would be. And again, when we looked back at our numbers, 8 of our top 10 investments would have been blocked if we had Corfo
It's
money.
crazy.
So for us as a fund, we jokingly say we love Corfo because it blocks a lot of our local competition. The biggest issue with Corfo money for Chile is that just the incentives aren't aligned correctly. Um, the simple math is that if you raise $4 million for of private money, you can get 12 more million from Corfo. So you got
Right.
16. You can charge up to 2.5% management fee, which is pretty high. US standards too. Many are even less than that now. So if it's a 10-year fund and you're charging 2.5 per year, that's 25%. What's the private capital? 25%. So you can take the whole private capital into the manager's pocket. And
That's crazy.
we've
Crazy.
seen some funds promote themselves as them being a good deal by saying, "Hey, we only take a 10% carry." And uh, people who maybe aren't as schooled in venture capital will say, "Well, that's good. They're charging me lower
Right.
fees." But when we see you're taking 100% of the private capital into your pocket
That's
and
crazy.
a lower if you're successful, it just says, "Well, I'm not going to be successful," right? So I think
Wow.
there's a lot of misaligned incentives between the incubators that get equity for just administering core for money, um, and the funds and companies that end up being zombie companies because they're just getting government grants every couple of years. But the good thing is, uh, Corfo is making a bunch of changes, and I think they will have some better stuff coming forward.
Good. Good. I'm glad. I'm glad.
So, going back to you mentioned China a little bit ago, and a lot of been a lot of news of China in Latin America with Tencent investing in Nubank, Didi acquiring 99, Didi launching in Mexico, Mobike, all sorts of Chinese companies. What are you seeing with China and Latin America, or specifically Mexico?
Uh, I, I actually think that's gonna be a momentous change in Latin America when China gets really serious about investing in the region in the tech sector. So what we're seeing here is basically a few tech Chinese companies betting big in Mexico. So you have the case of Didi, you have the case of Mobike, and then Alibaba. So they're getting in, they're hiring talent, they're investing tons, and they're starting to fight hard for the market, and that's great. So Didi is here, and they want to fight it with Uber, and that is a fantastic news because that in turn would lead them either to invest in funds, to invest in companies, acquire companies, and it will create an excellent dynamic with American investors and American tech companies that have frankly taken Latin America for granted for years. For years. It's absolutely insane that so many investors and so many tech companies are just running and betting the house on India and on China and forgetting about Latin America. So what your work in this, Nate, is actually very, very important and will have a huge impact if you're successful. In that, we need China to compete with America and the US, with Europe. So we're seeing the start of it. In some industries, Chinese investors and Chinese companies will be very important, and that I hope will start a trend that in turn will change the dynamic that we have today with the US and with Europe.
Yeah, it's super interesting, not even just in tech, but in just uh, investment in general. Since Trump and the government have started to uh, battle with China on trade, Chinese FDI was down 90 something percent into the US in the last quarter, while it's up 73% or 76%, I forget the number exactly, in Latin America to about 15 billion in the first half of the year. So I think while the US is sleeping on Latin America, China's starting to really wake up to it, which, like you said, I think is really positive.
Absolutely,
So
absolutely.
What advice would you give to those US companies and US investors who maybe have not looked at Latin America yet, or maybe done a couple of deals, but could do a lot more? Why should they be looking at LatAm?
Well, so LATAM is a huge market potentially. Obviously, there's a huge middle class that is very digital. You have a lot of tech companies doing, frankly, fantastically well. For Uber, Latin America is super important, super important for Facebook. So this is a great region if you're able to scale in this region, and it's hard. There are a lot of frictions. Each country can be a challenge, but it's definitely has a huge potential. So one of the things that I would recommend is take a flight. So if you do SFO to Mexico City, it's going to take you three hours and 50 minutes, more or less, and walk around Mexico City. You walk around Mexico City. I don't know if you've been here recently, Nate, but I mean it's amazing. I mean it's only the mobility sector is just crazy. So you see mobikes, you see scooters, lime scooters, bird scooters, green scooters all over the place. You have people using their phones to pay. You have people using cards that you wouldn't recognize because it's a credit card from a challenger bank. So this is really amazing. And then you have, when you're in Mexico City, you have the feeling of this infrastructure of huge corporates, a very sophisticated financial system. So there are so many things that when you're in Menlo Park watching TV and looking at the news about all the bad things happening in the north of Mexico, you lose the perspective of what's happening here. So first advice: travel here, travel to Mexico, travel to Chile, travel to Colombia. So that's the first advice. The second is talk to the people, talk to the founders, talk to the VCs. We have interesting things to tell, and it's really hard sometimes to get the time and to have them even look at a deck or even have a meeting with a founder. So that's the other thing for sure.
Yeah, we have the same advice. I mean, we actually show when we have some of our companies that go meet investors in the Valley or in New York, we show a 30-second drone video of Santiago because half the time the reaction is, "Wow, I didn't know there were tall buildings there." And that's real reactions from very smart people where they just didn't know, you know. So I'm with you. Got to come visit and take meetings with founders, even if it's only 15 minutes for coffee, just to
Exactly,
understand what's going on.
exactly.
What kind of books, blogs, podcasts, documentaries do you like to recommend, either about entrepreneurship or just life in general?
So I'm reading a pretty interesting book right now about the space war between the U.S. and Russia, which is really interesting. It's called let me see, where is it? I forgot the name. But it's basically about the Apollo 8 mission to the moon. It's called Rocketman, and it's written by Robert Kurson. So that's a book that I definitely recommend. Very interesting. The other thing that I recommend, the other book I recommend, is actually a book that I read on my flight back from New York, and it's a book about meditation. So we live in this very fast-paced industry. We almost have no time to think, to value what's important, um, and and meditation is actually a fantastic way to have not only a healthy life but a healthy soul. There's a book called The Art of Stillness that is fantastic. So I definitely recommend that. On blogs and Twitter and all of that, I don't have anything particular special to recommend. I would say you should go beyond TechCrunch, which I think it's a good advice. So definitely use Twitter. Twitter is such a fantastic space, and you can go and click and find new people, new things, and uh, things that are happening in Latin America are also happening in Nigeria, and it's also happening in Turkey, and it's also happening in Indonesia, and 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 there are so many things that are similar, but yet so many things you can learn from looking around the world about is being done. Um, I'm a big fan of documentaries. So actually, there's an old documentary series called Abstract in Netflix. I don't know if you saw it.
I haven't.
It's a design. Actually a design series. You should definitely take a look at it. So it's about architects and designer, which I think is uh, a fantastic perspective. But definitely, Netflix for documentaries is an amazing source of inspiration.
Awesome. And if you could go back to 2012 when you were just starting the first fund, knowing what you know today, what advice would you give yourself?
Uh, I would actually tell myself to have a little bit more fun, um, because this has been I mean, it's tough to build a VC firm, as you know, Nate. It's hard to being rejected when you fundraise, and you're rejected 99% of the times, right?
Yep.
So you can get a little bit anxious on the way, right? So you can think that it's going to be hard. You're afraid to fail. So sometimes it's you forget to have fun, and our job is just so fun, and we're so fortunate to be doing what we do.
I think that's a great place to end. I think it's great advice, and I'm going to try to take it to heart. Thanks for taking the time to do the podcast. I really enjoyed it, and I hope you have a great rest of your day.
Un placer, Nate. Good luck.
Thanks again for listening to this episode of Crossing Borders with my guest Federico Antoni from ALLVP. If you want to learn more about the Mexican startup ecosystem, check out previous episodes with Cristobal Perdomo, Matt Gutierrez, Albo Rodriguez, and Nestor De Arau, and more. If you enjoyed this podcast, please share it with a friend or put it on social media so that we can spread the word about what's going on in the Latin American ecosystem. Thanks to Angel and Sofia for producing this podcast, and thanks to you for listening. Have a great rest of your day.